Y'all, you are a sinus infection that just won't go away. Welcome back to the show. We don't stop streaming here. We just keep going because there is so much cool stuff to talk about today. Tax professional AMA. We got Carlos back on the show. He is back. He's always up here saying some really interesting things about taxes and finance and otherwise. Hex can been in the community for a while. And yeah, if you didn't catch the last open mic, that was a really cool conversation with him. Talked about Richard, SEC stuff as well. And so we got him back for AMA. We're going to go for a solid hour, maybe a little bit less today. So get your questions in. I already see one in the chat from Mr. Chuck, at least two, maybe one or two. We'll get to that first from Papa Boner's request. We also have Papa B in the house as well as Crypty. Crypty Girl is here as well. So without further ado, I'll get to chat in just a moment. Let's welcome everyone in. Papa Boner, Carlos Quintana, and Crypty Girl. How's it going?
Everything is going fantastic. It's great to be on stream with you all.
Yeah, welcome back.
Yeah,
Papa B as well. Carlos, yeah. It's a wonderful day. It's a little bit fair weather. Carlos's area over there. It seems like inside joke. Everyone in the stream, you'll know what I'm talking about. But we've spent some time in the green room conversation, and we've refined. This is going to be a running thing. We've refined it quite well.
You know. Speaking, Max, about the green room, I didn't realize that refreshments were not going to be furnished for the guests. I was waiting for my open-faced. Yeah, I got this rusty-looking water, and that was all I got. I was promised open-faced sandwiches, but I got nothing. And then you guys are talking about these amazing foods and things. So thank you for the torture.
Did you buy the VIP package? Is that?
I thought so. What is there one?
Yeah. Carlos got one.
I got the VIP package, Papa.
Yeah, you got one.
What?
I know.
Yeah.
Is it that box that's underneath my chair? Shall I take a look? It's got chopsticks wrapped to it too.
It's kind of late right now. We can take a look at the box later. The unknown box under your chair. That's interesting as well, though. But yeah, the VIP package. You gotta invest. Crypty got half price because she bought early too, right?
That's right.
I'm always left out. I don't tune in enough.
Well,
got
today,
the West Coast special.
yeah, if you're a local, yeah, you always get a discount. Again, if you come to local meetups and stuff, you get free swag. I've given free swag. I've received free swag. It's pretty awesome. We like to take care of the Hexicans around here. Yeah, let's. There's a first question in the chat. I want to get to here. Well, first, I gotta say hi to the Chad of Chads of Donner Swans. He got a couple pumps in, decided to come by and learn about whatever we're talking about today. Also, Freddie Quotes is here. Welcome, Freddie Quotes. Anyways, first question. Mr. Chuck, is CoinTracker and CoinLeaf for crypto taxes safe? Is it convenient for TurboTax, but is operational security risk? What do you think, Carlos and panel?
May I answer to the best of my opinion? The answer is yes and no. In terms of OPSEC, I would never connect up a live account on a SEX to Coinly or any other coin tracker like this, no tax software at all, via the API. Because, I'm very skittish about API connections because they are inevitably the ones that attackers can use to commandeer your account and steal your goodies. That's my 2 cents. But as far as passively entering in your public addresses, it's very secure.
Yeah, the transactions are already public record. So as you go ahead and download those transactions, you upload them into software. It'll simply just calculate what's already public. So there's really, in my personal opinion, no risk. But I'm not a security professional online. All I know is that it's already public record. The connection, you don't have to connect it directly to any live wallet or anything like that. So you do have the option to manually upload transactions to CoinTracker, to Coinly, and any other software that is available. Now, if there's something weird about a software that you're noticing and it says like sign these contracts, blah, 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 like, okay, hold on, you're probably in the wrong website or something. But I wouldn't say it's a risky thing.
Gotcha. I think it just cryptotext. Yeah. As a person who works in security for a long time, trying to think myself to operational security risk. I mean, if anyone steals your stuff, they steal your stuff, that kind of thing. As far as OPSEC goes, if they look over your shoulder to see your passwords or or otherwise be able to get a hold of your, your hardware wallet. If you don't, me and Papa Owner talked about before, if you don't have a PIN, there's things where people can dump all your seeds and all this stuff too. But yeah, as far as, connecting the stuff, I don't know. I feel like a lot of people are going to do it, and then a lot of people are going to get, I don't know. I don't think it's like a specific thing to CoinTracker or Coinly. I guess I'll phrase it like that. It's not something I worry about specifically to them or TurboTax, but it's just more of a, if you're asking OPSEC, then that's more of an OPSEC, how you treat your data. Do you walk around with crypto t-shirts? Where do you store your hardware wallets? How do you write down your seed phrase? It's more of that kind of question than specific to these. I'll put that perspective out there. Anyways, good question, Mr. Chuck. Crypty, anything to add? Just a nod, or do you have any experience? Do you have any experience using any of the trackers, by the way, any nuance you have there?
Yes, but it escapes my mind right now. But I have been using one over the past few years, and it's just kind of flawed. There's no crypto software that can track airdrops and, account for the yield coming from HEX staking or burning your tokens in a sacrifice. So you really have, I don't know. I double check everything. I do a lot of it manually, but I also have the trackers help.
Yeah. Is there any plugins I thought Carlos mentioned this before. So there was like something where you could maybe a plugin or some modification you could do to track HEX stuff? Or does some websites support that?
Well, every software is going to go ahead and show you the transaction, and just because it shows whether you send it to a null address as if you were burning the coin, but it's sometimes it shows up as a different address. And what you have to recognize, as Crypty mentioned, is that you still have to go in and review the transactions, because a burning address is not always the same way, right? It could be like a regular public address that when you click on it, it's a burning address. Or it could be like in the HEX protocol that when you burn something, it shows up all zeros on the address. So every time that you interact with a certain protocol, it's going to need some sort of review. And when you receive the yield on specific protocols, you're going to have to treat it differently. If you're interacting with a smart contract, then you want to treat it as capital gains. If you're dealing with regular yield is other income, and then you have to tag it as a reward. And if you are doing like mining or staking for the sake of the proof of stake network, and you're securing the network, then it's going to show up very different. Now, the treatment in itself is going to depend on how you're tagging it. So reviewing the transactions is necessary. So it's not something that is going to be completely automatic that says, okay, I recognize that you're interacting with the HEX protocol. I'm going to recognize these transactions a specific way. I hope that there is some advancement later on that says, okay, there has been some definition of it. But right now, it's almost impossible to do that due to the fact that regulation would have to come out specifically on each one of the protocols into how it actually needs to get treated. And people change their wording all the time. Like HEX was interest, and then it was yield, and then it was mining. So how am I going to let the software know that this is whatever it is that this protocol is saying, when in fact rules and regulations are supposed to be followed no matter what the language is that they're using? You're supposed to analyze the protocol and know whatever it is that you're interacting with, and then tag it in that specific way on the software. So right now it's just very chaotic.
Carlos, I got a question about that. And, I think that a reason that I really wanted to come back is because when you speak these volumes, you hit on so many points of where clarity is not present in the market, right? Mm-hmm. So I just wanted to unpack that final point that you made, which is that you're supposed to know, you're supposed to review the protocol, and you're supposed to understand exactly what's going on. Yeah. In lieu of that clarity, consistency throughout our community, or is it throughout the world, the government doesn't make any clear distinction between that. So if half of one quarter of our community says that these gains are short-term, long-term capital gains, and the other 75% says that no, the inner workings of the back end point to the fact that this is just income. where do we have like a central think tank that determines where we're going to take our stand with the government? How do you deal with that as a CPA?
Well, it's not really about, like, every stand could be a valid stand. And the IRS requires you to be at least 51% confident in the decision or in the position that you're taking legally. So
Okay.
if you're able to defend a position based on the information that you're given, it's all like, there's no such thing as the IRS as like a machine. It's more like when you get reviewed, it's a one-on-one person. So it's your job to explain it to another human being that has a different perspective on whatever it is that they're reviewing. And as you provide information and evidence to substantiate your position, they are going to say, well, that's a valid position, or you know what, that doesn't really make sense, because based on cases or based on these sort of protocols that interact the same way, based on your explanation or based on the evidence that you have provided as far as how it actually works, I'm going to go ahead and say that your position is invalid, and therefore I'm going to disallow it and treat it this way. So the there are only certain concepts in the tax, in the IRS tax code, that are just like, this is what the IRS tax said. But even as something as simple as just a donation could be done in a way that you either, even if it's a legitimate donation, you can just not have the 3 or 4 different evidence to support your position, and therefore it's completely disallowed, even though that you might have done something that is legitimately to a 501c3 type of organization. So something as simple as that could be completely disallowed. Imagine what we can go ahead and expect when they're interacting with you in a conversation that you have to substantiate all the evidence, your position and everything. It's going to be a debate. So it's your job to make sure that every decision that you're making and how you're categorizing everything is defendable, and you have enough evidence to substantiate that position that you're taking.
Yep. And your tax advisor is effectively your counsel. So if you can't make it fly with them and say that it's a legitimate, defensible position to go forward, it's probably not going to be. You're not going to have anybody in your corner.
I get a lot of people. Exactly. You're not going to get anyone in your corner. Like, there's people that come to me with certain positions, and I just listen. I'm like, well, how would you defend that? Okay. Yeah, that's not going to fly. And I have to throw it down. And they're like, well, I still want to do that. I'm like, well, okay, you can go ahead and do that. I'm not going to sign off on it. But sometimes they come in and, like, for example, the first time that I got approached about HEX, I was like, but what is this though? How does it work? Oh, I didn't know that you burned the token. Oh, I didn't know that there was a smart contract that you interacted with. And then we look into regulation into, well, how do you then interact with the smart contract, and how, when you are minting new coins into existence, how are you going to treat it? And then, therefore, the conclusion into how to treat it becomes into, well, compound a protocol is a smart contract that increases in value over time, and therefore is being taxed as a capital gain. We have some similarities here. We can make a defendable position into that smart contract in the HEX protocol is minting new coins into existence, and therefore the yield is going to have that deferred capital gain tax treatment other than just income, even though that the language of the protocol is mining, right? So the dynamic of it, people will go ahead and explain, and I can just say, yes, I can defend it, or no, you know what, that doesn't really fly. I'm not going to use that. You shouldn't either. You should be more conservative in this approach, and therefore that's defendable, rather than taking an aggressive approach and trying to write off $1 million in capital losses.
Right. Okay. Sorry to grab the mic so much. I want to role play and assume maybe that I was your client and you were my CPA, just for a couple of questions, just to try to bounce this off of you, because this will both allow me to ask the questions that I couldn't ask last time, and also, to your point, we can see how this interaction can be between a client and a CPA with some wacky ideas, and see if I'm on the right track and if you sign off on them. And of course, you're not held professionally to any of these opinions. This is just a role play. Just that's the the fine print on this one. So number one is I was kind of yelling at the screen last time because I couldn't ask this to you. There are cost basis schemes known as HIFO, LIFO, and FIFO, right? It's first in, first out, last in, first out, and highest in, first out. And you mentioned all three of them in the last stream. And my understanding is that once you choose in one asset class, one structure of calculating your dollar, cost basis, and then how they're disposed of and how they're matched up against everything that you bought in the past, that you are locked in for that for the duration. That is, you start down the road in crypto and you have first in, first out. You have to adhere to that forever, for the rest of your life, effectively. Is that correct?
Yeah. Yes. Short answer, yes. There's
Okay.
a little bit more to explain about that. So the United States has a very specific way for you to use the accounting method. So what you're referring to right now with the FIFO, HIFO, LIFO, that's called the accounting method that we use to calculate the cost basis of your inventory. So when we then choose an accounting method, you only have two choices. You have specific ID or FIFO.
Good.
So FIFO is, as a default, the way that the IRS would want you to calculate the cost basis of whatever it is that you have. Now, based on that calculation of cost basis, that's what's going to determine your capital losses or your capital gain based on what you sold or interacted with during the year. Now, specific ID has a freedom to choose from FIFO, LIFO, HIFO. Now, there's an accounting method out there called the average cost, but that's not going to be is used in the United States. That's only used in Canada and the UK. So even on the software that you have in the United States that you pay the subscription for, they're going to give you the option for average cost, but don't use that one because it's not allowed in the United States. Specific ID refers to a specific way that you need to record the transaction. So that's why we like to use those tax softwares, because then we have the specific ID of the transaction that requires date, time, et cetera, as far as the coins that you have. Once you have all that data for all those transactions, then you can choose between those three different accounting methods. But if you're tracking your own data because, for example, you have concerns with software security and you're doing your own Excel sheet into the calculation of your cost basis, or like Coinbase is giving you a summary transaction report, you have to use FIFO like automatically. And if you don't have, because you don't have the specific idea of each one of the transactions that you have, right? So that's the first thing to determine. Are you going to go ahead and have specific ID, like meaning that you're going to record every single one of the things, even the time and the second with the fair market value pricing and everything for that transaction? Once you have determined that, then you do keep the same accounting method moving forward for that specific asset class. That doesn't mean that you have to use the same FIFO accounting method for stocks as well, or for any other type of asset that you're getting involved in. It's just because
crypto,
it's just specifically crypto, because you imagine this, right? I calculate the cost basis of all my HEX transactions and my HEX thing for a whole year, and then suddenly I got rid of all the first in, first out. So the first cost basis that I got is the first one going out. Whatever cost I have on the beginning is going to be lower than probably what I got at the end. So imagine I got rid of the first in, first out, and then next year I do last in, first out. The inventory is going to get messed up because I might have grabbed already maybe from the same inventory, or I'm grabbing from a different portion just so I could play with the capital gain and capital losses. The inventory that I have is already recorded, and whatever you do in 1 year is going to get stored and move forward to next year, because then the same calculation of cost basis has to be calculated over a period of time forever. And in that case, you will mess with how that calculation is done. And that's why you have to stick to the same accounting method for the duration of your investing activity and that specific asset.
That's an excellent answer. And I love the fact that you opened up the box about specific ID, and the fact that there is a FIFO and then there's the flexibility of specific ID. However, you as a human cannot cannot calculate the butterfly effect if you were to ever alter things manually. That is, I consider Coinly and all these other software, tools to be able to calculate all that on the fly. I don't make any accounting changes, but to the best of my knowledge, they can. So if I select one accounting scheme and then I make a change manually, because specific ID effectively is a manual option for you, and you can flip back and forth, but you don't want to go back in time and blanket push HIFO if you've been calculating FIFO the entire time, like you said. Yeah, exactly. But for editable contract or editable transactions, it could be very valuable because you could say, "Oh, I just sacrificed." Okay, sacrifice will be now a deemed sale at $0 because I had knowledge of it. It is disposed of. I got back nothing, and then it goes away. It's not a burn that I didn't know about. It's not something that I didn't initiate. It's not a loss, like I lost my keys. It's simply a deemed sale, and that affects the cost basis of when I first bought it. But I want to find the highest cost basis to take that maximum loss on the deemed sale. Therefore, now I'm using my specific ID to go back in time to find exactly what block I've just disposed of. And this only works for somebody that makes fewer transactions than, let's say, a bot trader. A bot trader would be screwed, but me, having traded almost nothing, can do such a thing. And that's basically the question that I had for you. I'm just one person, and I have all these different combinations of things that I do, and I throw it over to my CPA and I make a case. Do you think that my case has been adequately made that you could get behind it?
No.
No. Why not?
Because you haven't given me context on a deemed sale. And I think that my understanding of a deemed sale is different than your understanding of a deemed sale based on the structure into how you presented it to me now. So
Okay.
I would ask you a couple more questions, not saying that I'm going to say that your answer is or your context is incorrect, because it could be correct, or I could defend it. I could
Right.
get behind it if you give me more explanation based on the advanced type of structure that you have given me now. I know that
Okay.
you have done a little bit of research already. You have a understanding of the accounting methods. I just want to be a little bit more clear about your definitions, specifically because those legal definitions are going to make a difference, right? So
Right.
my follow-up question would be, well, what is your understanding of a deemed sale?
My understanding of a deemed sale is it's a known disposal of an asset for a dollar valued token of any kind, or nothing. So it's basically another way, I feel, of identifying the disposal of an asset on a market.
Okay. Could you give me an example of that? Not in cryptocurrency, but could you give me an example of that in with another type of asset?
Sure, absolutely. So you and I are from Southern California, so we know that there's a lot of people that come by or they advertise, hey, bring your used car in. If it's a junk or if it doesn't move, we'll buy it from you. So okay, I've got an old Honda Civic in my front yard, doesn't run, and I want to take a write off for it. So it's not really worth anything on the market, but I then agree with the junker, junker, whatever it is, will come by my house and they'll write me a receipt for $500.
Okay.
So that then is an asset that I've deemed sold or deemed a sale to the clunkers for junkers or junkers for, remember that crap a long time ago?
Right.
Anyway, they gave me $500 and we've accepted between the two of us that it's got a value of $500, but on the market, it didn't.
Okay. All right, great. So that's a good explanation. But now let me go ahead and share maybe a couple more examples of what a deemed sale would be considered in the accounting world or in the tax world. So, for example, if I have a company that I sell to you, Papa, and I tell you, hey, you know what, I'm going to sell you the whole company, the whole intangible list of clients, plus all the assets inside of the company, the desk, everything. I'm going to go ahead and sell it to you for $1 million. Now, what could happen in there is that I am change the world for the word of deem to assume to. It's a hypothetical sale. It's
Okay.
not that it actually happened. It's a hypothetical sale that I'm assuming that it got sold. So, for example, I have an asset such as a desk, for example. I sold you the company. I deemed it to be sold because I sold you the whole company as a whole. But now we encounter a problem with deem sale. And Deam Sales is a very advanced topic when it comes to the accounting and taxes, and it's a pain in the butt. So the reason of that is because since you have a basis on the asset in itself and you deemed it to be sold or assumed to be sold, hypothetically, you didn't really enter into the transaction of the sale. If you have an appreciated or built-in gain, for example, on that asset, you have to pay. The fair market value is what is assumed. So in contrast to what your explanation was, is that you needed to calculate the cost basis of that deemed sale so you can write off the cost basis. Now, in my explanation, what I'm saying as far as the contrast between that is that the deemed sale is at the fair market value when you assumed it to be sold. So therefore, if you have, for example, HEX, and you deemed it to be sold, and you got it from the yield at a zero cost basis, the fair market value would be what you when you basically send it to the sacrifice is what you deemed it to be sold, and you would actually be subject to paying capital gains on that. Now, in contrast to that, or the other scenario would be if you bought it at 50 cents and then you sacrificed it at 20 cents, then you deem sale, and then you have effectively a capital loss based on that assumption of a deem sale, not based on writing off the whole cost basis that you paid for on that specific asset. It's basically as if you were recording a transaction in your crypto report, as if you were really exchanging it for another type of token. So in this context, that could be correct. Like if you're actually doing those steps of actually making that assumption of that whatever you donate, whatever you sent into the OA is a deemed sale, you just have to basically record as a sale. You make sure that you actually are recording the capital gain. And in our case, we had a really highly appreciated asset. So in my case, then I think about your position, Papa, and then I say, well, if we do this, you're going to be subject to capital gains tax based on the fact that you actually submitted, based on your accounting method, appreciated HEX. Do you really want to go ahead and do that? Or do you want to maybe just ignore out the transaction based on maybe other positions that we might be able to take? Because there's like 3 or 4 different routes that we can take on the sacrifice. We cannot just assume.
Right. I'm sorry. I left out a very important suffix on this entire description. Deem sale at $0. So it was. So I did know about it. It was disposed of. I got nothing for it.
So it'd be a loss each time.
It would be the loss if you can go back via specific ID, correct, Crypty, to go back and associate it with a point in time where that lot was purchased, establishing cost basis at that point. If you can connect them up without ruining this beautiful, butterfly effect scenario, then I think you've got a defensible position.
It's a tough one. It's aggressive, and I don't know if I would go for it. I think that you could have a defense based on that, but also there's no cases that I could recall based on deemed sale in this specific scenario where you can just say that this is deemed to be sold because you actually sent it somewhere. You see, you're not assuming for this transaction to just have happened as an assumption of the sale. Like the actual transaction actually got recorded. It's like if, for example, if you were looking at worthless stock, how are you going to record the worthless stock? Well, you still have the power of the stock. You still hold it. It's just deemed to be sold because the court said that it was worthless because there's filings of bankruptcy, and therefore you can actually write off the full amount of the fair market value at the moment of the deemed sale. But you see, you actually sent it somewhere. So
okay,
and it wasn't.
But that's the deemed part, though, I thought.
Well, the deemed part is when you assume it to be sold, but you actually sent it somewhere with an intention of profit.
But in this case, in the case of sacrifice, we swear up and down we didn't have any expectation of a profit.
Well, was that
whatsoever.
true?
Uh,
Was it true, though?
no, the question is really, is it a defensible position to say that it was true?
Well, I don't know. I think that if you do a poll around everybody that participated on the PulseX and Pulse Sacrifice, and you ask them, did you have an expectation to receive the airdrop? 100% of people will say yes. Well, they might just lie about it, but we all had the expectation of that.
Well, we had the expectation of points. We were
Points is
definitely
in-
given, and the points had no, they have no true attachment in clear legalese. I don't think they have a true attachment back to the sacrifice in terms of dollar value or even coins,
Well,
right?
that's a whole argument right now, right? That we have to
Yeah.
determine whether there was actually a securities sale or not. That's the whole point of the SEC lawsuit against Richard Hart. So, we're yet to determine whether that was actually a security law. Because as you read the Howey test, well, Richard Hart swears that he has a defendable position against it. As you just read the basic stuff, yeah, sure, legally, and as far as like the story behind it and things that were written, yeah, but the reality is a different one, because we all expected something in return. So it's going to be a going back and forth about this topic, and this is the thing, though, Papa. I'm going to be looking out for my clients to see whether this is a defendable position or not. Now, am I going to be willing to take on the fight, for this specific thing? I might be able to just completely defend that, but I would have to be like very sure into getting IRS codes, specifically talking about Deam Sale, and have other cases to substantiate the position in itself. And I don't think that there's enough evidence for me to be able to come up with this conclusion that this could be considered a Deam Sale at zero for me to be able to write off. Now, have I done it? Well, I'm not going to confirm nor deny, but
Right. Yep.
but the thing is, is like it's up to the taxpayer to be able to determine whether they want to take an aggressive position. And just know, from my professional opinion, that would be an aggressive position to take. And therefore, if there is regulations or legislation that comes later on, you would be forced to amend and pay penalties on that tax liability that you wrote off. Now, how likely is this to be audited? Or how likely is it to get reviewed? I think it's very highly unlikely.
Okay.
But it's up to you to take that aggressive approach that could be defensible, or make more of a conservative approach where you maybe ignore out the transaction so you don't have a big write-off. And I'm talking about, there's a difference. There's people that sacrifice $500 and there's people that sacrifice millions of dollars. So it really depends on a case-by-case scenario. When someone is trying to write off $1 million, well, I don't really know about that. When you may be able to take a Deam position, that would go to the Supreme Court. You would have to fight it with attorneys, all these different things. Do you want to go ahead and take that on? Sure, go. That'll help the whole industry out if you want to go ahead and fight it. Do I want to take that position on $1 million capital loss? Probably not. I may want to be a little more conservative about that. So I think it's a case-by-case scenario. Can I confirm that your position is defendable? I wouldn't be 51. I wouldn't be at least 51% confident into defending that position.
Okay. All right. Well, how about 6 of one, half a dozen of another? What if you say, "Hey, I'm going to take the capital gains on it because I knowingly sold it for, let's say I marked down that I got it for $1, but I'm going to take all the gains out, and then if and when I were to receive points, and if or when those points were to translate to tokens, I will then say that I received those tokens at $0 anyway. So I'll be paying the full width and breadth of all the taxes that will come when I dispose of those later on. Either way, it equals the same thing. Whether or not the CPA thinks that it's a defensible position or not, or aggressive or not, is what you're getting at, is that as long as you have a relationship with your CPA and they themselves are willing to stand up and say 51% sure that this guy's not telling a lie, then that's all that really counts. Because I don't think CPAs have this clairvoyance where they really communicate. There's not a database where you guys actually have CPA interpretation shared. It's basically your gut. That's like any attorney. Your gut says this is either worth the fight or not. Yeah.
I mean, there are places that we do talk about it. Like I'm part of a big group of tax attorneys in New York, and that we do discuss certain positions that we take. And like, for example, what I told you about the Austin, the conference I spoke about, I was one of the national speakers for cryptocurrency and taxation, teaching other CPAs on how to record
Good for you.
transactions, recording transaction. Thank you, Kriti. And what happens is that even those positions sometimes could be, like, for example, I had a tax attorney trying to defend that an airdrop fair market value is supposed to be recorded at the time they sold, not when it's received. And I was like, well, what are you basing that on? And you can go deep into the tax code to grab a couple words of interpretation just to flip it all around. So as you say, even if we do have clear guidance on certain things, our interpretation of it might be something that is challenging for other people to understand, and we might be able to take that to court or into an audit and be okay with it. So it is a case-by-case scenario, Papa. So I would just be careful into the type of positions that you're taking to make sure that you're not going to get into a position where you're going to have to revert certain things, and then you have to have a risk assessment into, well, this is going to cost me this much if in the future I'm going to have to return or pay $100,000 of taxes plus penalties. Can I afford that? Yeah, definitely. Okay, great. Take it, But if you're like, I'm not going to be able to afford this at all, don't put yourself in that position.
Good questions, Papa. And I'm excited to see Carlos, create some new case law that's pro crypto going forward. If he ever wants to take on the fight, maybe we'll see some new stuff come out of it.
I'm good.
He's like, hey, you know what? We got a lot of other people who can do that. You're not wrong. There's a lot of rich people in crypto, and maybe they're working behind the scenes, but we certainly hope they're trying to help out.
There's a whole group of lobbyists working for all of us. Obviously, they have an angle. They make money, with certain things, but at the same time, there's a whole group of lobbyists, crypto tax attorneys, fighting for the rights of crypto holders and the privacy and the right for us to hold property.
Well, that's good to know. Yeah, great questions, Papa B, and the perspective from you, Carlos, is just really good to learn about. So my question is regarding liquidity providing. So when you're putting up your own assets on the DEX for others to trade into, and let's say I want to become a liquidity provider just towards the top of the market, so it's kind of a smooth exit. I do a stable coin pair. And so most of the people are still buying in towards the top of the market, but I'm in return getting stable coins for liquidity providing. And so it's not a direct sell. It's not like a transaction. It's more an indirect event. Is that a non-taxable event?
You bring up a good debatable topic. There's no guidance on it as far as what liquidity providing is and what is not. So what we have to go based off is how does it look like on the tax report? So the way that it looks like, it depends on if you're in V2 or V3, right? So liquidity providing is very different depending on what version of the DEX you're trading in. If you are doing V2, you're making a pair, and then you're putting that into liquidity, and then you can exit that pair. Now, the way that it looks like is as if you went from one transaction and you sold something to get another pair. You got USDC, US, whatever, those two pairs, and then it became USDC, UC1, just to give you an example. The way that it looks like in the transaction is like as if you actually traded those coins for another coin that it has a mixture of both names in it. And then when you're exiting your position, it looks like you actually then separated those things, and it records it as a transaction. So there's no guidance on it. Can I record it as a non-taxable event? Well, if I'm looking at the intention of it, yeah, it's kind of like a non-taxable event because I'm not trying to profit from the trade itself. I'm trying to get the revenue from the transactions that are happening because I provided liquidity into the protocol or into the DEX. So I cannot confirm that this is a non-taxable event. As a matter of fact, the way that it looks like is that it is a taxable event, and I will record it as a capital gain transaction based on the fact that it looks like I traded one token for another one, even though that we know that your intention wasn't on making a profit based on that transaction in itself. It was because of the revenue that may come after for the liquidity providing. Now, V3 is different because you could actually provide liquidity, but the way that it looks like on the tax report is as if you purchase an NFT. So then we look into this and we're like, well, there's a whole regulation about NFTs and how they want it to be taxed as collectibles at a 28% capital gain rate. And if we see that you're purchasing a bunch of NFTs and you tell me as your accountant, hey, those things are not NFT purchases, they're actually liquidity providing. Well, the IRS is going to look at it. I'm going to look at it. And I'm like, no, you purchase an NFT. Even though that the language that we're using is liquidity providing V3. But the way that it looks like is as if you actually had a taxable event purchasing an NFT that produces whatever revenue, and then you exited the position and then you got your coins back. It looks like a taxable event. Now, the conservative approach is based on the current regulation and rules that exist today, not what I think will be in the future. So if I am basing the recording of the transactions as of today, I will record it as a taxable event, and I will go ahead and have you pay either capital gains or record it as a capital gain or capital loss based on that, because that's the only thing that I know could be defendable. That's the only thing that exists and the only guidance that exists for now. So even though theoretically speaking, liquidity providing, in my opinion, is not a taxable event, the practicality of it is different, and therefore I will record it as such.
That's very interesting. And I appreciate you sharing the difference between a V2 and a V3 and how it looks differently.
Yeah, for sure. You're welcome.
Can I ask one point of clarification on that?
Yeah.
Are we going to ignore the use of the words either coupon or note? Could those fit?
I've never heard of those. What do you mean?
Well, I mean, if rather than NFT, if you say that this is a electronic offering of a coupon for which I have a placeholder for my liquid. Yeah, and like an IOU, yeah. So you've lent it to the pool for liquidity, effectively.
Yeah. But the way that it looks like on the blockchain is as if it was a taxable transaction.
Okay.
You know,
damn blockchain. Okay.
I know, but it's the same thing as burning and minting, right? What happens when it shows that you're minting and burning? Is that a taxable event? Well, that's a whole debatable point as well, because theoretically speaking, it's not a taxable event because you're simply burning coins and minting new coins into existence. So we have to grab certain context and we have to be able to defend certain positions to be able to be like, oh, I'm going to merge these two transactions and then I'm going to remove the yield. And that's exactly what we do with a HEX stake, right? You burn it, and the way that it shows on the blockchain is the send to zeros, and then it goes from zeros to your wallet address, but with a different amount. What it came in and then what came out is different than the initial balance. What you need to do manually is to separate the yield from the capital and attach those two transactions so he knows that you send it to pool and then you brought it out to pool with the same fair market value, with the same cost basis, and the yield itself is going to have a zero fair market value, and you're simply going to put it as a separate transaction because that was the yield that came out.
Coinly does this, thank God.
Well, it allows you to do the manual transactions, and there's a lot of softwares out there that allow you to do the manual transactions. But this is the thing, it becomes a very complicated thing. If you're very involved in crypto, not just on the HEX protocol, but you're involved in many other protocols, you have to know how they work to be able to guide your CPA to be able to do this, or you yourself need to come up with a report. And the good thing is that Coinly and Crypto Tax Calculator and other softwares offer the white glove service where they'll do the report for you. It's expensive. It's like $2,500 to $5,500. But then they'll take care of the report for you, so then you can just go ahead and give it to your CPA, and the CPA just simply reports.
But you can take the one that you specifically review yourself and edit and check, of course, and that's only about $100. You click the button, and it does the entire tax report to give to your CPA.
So but what I'm talking about when you have complicated transactions, such as entering manual transactions to be able to separate one, you may. If you are rookie about it. Like if you're new to the whole thing, you might make mistakes, and the CPA is not going to know any better. So it falls under you and your responsibility to be able to distinguish what protocols you're getting involved in. And
as far as I'm concerned,
yeah,
half this game is tax planning. Half of this game is tax planning. Making the money is half of the uphill battle. The other one is keeping the money. So
Isn't
obviously,
that
it is sad. And if you win, you just stay out of jail.
One more question before we wrap up, because I know I wanted to ask Carlos about anything new going on as far as regulations and stuff. But let's get this question. Sorry, chat. We've hopefully answered a lot of questions through Papa Boner taking 35 minutes to go through his role play scenario.
35 out of 45.
That's
a new record. I'm an asshole. Yes.
It was it was excellent. It was appreciated. But that just takes away from chat's time. But that's what we got. I think it's more valuable this way, anyways. I think we have some good. We talked about a lot of good stuff. Anyways, investing crypto via a Roth instrument. Does IRS need to track all those accounts, Carlos?
Well, that's a very interesting question, because theoretically, no, because it's a non-taxable distributions anyway. So does it affect the IRS whether they track it or not? It's really not a big deal just because it's a non-taxable thing. Now, they do have reports, and you have to do a self-directed IRA within a certain account. And that account in itself is going to be able to be publicly traded. Now, you don't have to report it anywhere. So what's the point about you creating the specific ID report or this and that and that? You don't have a filing requirement of that account. So can you still track those accounts? Sure. But I mean, it's, in my opinion, pointless due to the fact that it doesn't record a tax return in which we have to disclose each transaction under Form 8949 as if it was an individual tax return. So in this case, I would just say that no, it's the IRS still need to track those accounts. I would say, I am not 100% on this question as far as whether there's a requirement or not, but theoretically speaking, in my professional opinion, there's no point in doing so because there's no tax return that needs to be filed for that Roth IRA account. And when you get the distributions, it's simply just based on the fair market value of the portfolio itself. So I would just leave it at that.
Gotcha. All right, that is the last question we can take today, except mine. Carlos, anything going on as far as new regulations or anything that would affect crypto or our community that's been going on lately?
Well, there's a massive one called the Inflation Reduction Act, and there's been a lot of talk about it, and the Treasury was open up for comments, and the IRS was open up for comments about how this Inflation Reduction Act would affect people, whether in a positive way or in a negative way. And the fact of the matter is that this proposal is meant to kill crypto, is meant to kill DeFi. And it would, if it passes, it will kill it. And it's a very risky thing that if we don't get involved in, if we believe in DeFi or if we believe in crypto, especially if we have our money in crypto, it's like we want to make sure that Stays alive due to the fact that we don't want to just lose all of our money, right? So the Inflation Reduction Act basically would propose that even if it's DeFi, it would invade the privacy of everybody, because now everybody needs to have a 1099 DA that basically discloses the transactions. And imagine having that many forms for all your transactions and having your social security number out there. I mean, these are sometimes the DeFi protocols that we're involved in, and I'm not saying you or I, but I'm just saying in general, as a crypto population, they're not very trustworthy. How many fraudsters are out there? FTX and this and that and Celsius, and we hear about one almost every week. How am I going to be also sure that they're not going to sell my information out there? So this is a breach of privacy, 100%. where we have to disclose our social security numbers to every single transaction that we're doing, no matter where it is. And DeFi, it's a complete breach of security for everybody and privacy as well. And not considering the fact that, imagine like all the 1099 universe that we have, right? The 1099 NECs, the 1099 miscellaneous, all that. There were about 3.2 billion forms produced in 2020, 2021, something like that.
Wow.
If this passes, the forms that would populate would be 8 point something billion forms.
Oh, holy cow.
Right? So
Mhm.
that means that, well, everybody would be completely turned off into doing anything in relationship to crypto. So that's why this is intended to kill crypto by an overload of legislation, compliance, and this and that as far as like the forest. Because if you don't follow that, there's very strict and very heavy penalties on you interacting with a crypto protocol where the DeFi platform that you're using is now considered a broker and you're not following certain procedures, and et cetera, et cetera, et cetera. So this Inflation Reduction Act is really meant to kill crypto, and we have to be very attentive into that. So that's kind of like what's going on. There's already been about like 13,000 comments from attorneys and other professionals that have submitted their professional opinion about this. There's even an AI tool that helps you draft a letter for you to pose your public comment about it. I think that they already closed the date as far as the commenting. I think it was like last month or whatever. But, we still have that pending arrangement to see what is it that they're going to do with that. And thankfully, the whole crypto industry came on and said, hey, let's go ahead and do something about this because this is crazy. As far as any other regulations, I mean, we got the confirmation that rewards from proof of stake networks are taxed as ordinary income. We used to have the whole case with Tesos and the lawsuit with the IRS that happened, that they were debating whether property created by the taxpayer was non-taxable. Well, we got confirmation that it's taxable as a reward, and whoever has proof of stake staking, like in PulseChain or ADA, like with Cardano, that they are, securing the network because of that, or ETH 2.0 with the 32 ETH that they have to put it. All of that is going to be recorded as income. We recorded as income anyway since a long time ago, based on that assumption, but it's been confirmed. So those two legislations are the newest things that have come in relationship to the crypto industry.
Got it. Well, thank you for sharing about that. It's really important to stay aware of and be on the right side and fighting for freedom and not have it totally totalitarian.
Yeah, well, you definitely have to get involved in the things that you believe in. You sometimes have to be put into a position where you have to make a stand for what you actually want.
Carlos, I just one comment on what you said. Sorry, Max, I broke my silence. The way I see it right now, I have maybe a more rosy outlook on things, even if this whole thing passes with the Inflation Reduction Act. I would say already it's a huge turnoff to try to keep track of all of your transactions, and things like Coinly and other trackers already make a 1,000 page document that I could never make myself possible to deliver to my attorney, who then looks at just the summary and then passes it forward anyway. If this does come to pass, that it's more convoluted and more arcane, what I'm thinking is that there'll be just a bolt on and a price that you pay for Coinly Pro, and it'll do all this checking and all this logging and all this, making sure that you're handling yourself as a broker. The only thing that you can't do with Coinly is get a license that maybe the SEC or the IRS doesn't issue or identify. That's the only thing that I would fear. Otherwise, paperwork be damned. It's already terrible. It's already a huge turnoff for so many people, but it's manageable.
Papa has a previous career as a compliance officer, so he's very comfortable with billions of paperwork.
It's all virtual paperwork anyway now. We don't write things down with paper and pen. Come on.
No, but like your tax return now, instead of being just 20 pages, becomes a 400-page tax return. It's just incredibly crazy, all the things that we have to do now.
Well, you shouldn't complain. Those are billable hours.
I don't, the more regulation that exists and the more confusion in the market exists, I make more money. So I
Exactly.
don't complain about it. But at the same time, you have to sometimes just, fight and be like, hey, this doesn't make any sense. Plus, you're killing my bags, man.
Yeah.
Why would I want the government to kill my bags and
It's
in my investment?
self-destructive.
If people stop
Right.
trading and stop having bags, then Carlos doesn't get paid at all. So
And then we don't pay big tax bills either. So remember that, IRS.
Yeah, exactly.
yeah. Somebody big step up, fight for freedom. We can all do it collectively together by doing a lot of, we did a lot of the public comment stuff. Me and Coffee and a lot of other people talked about it as well. We got a lot of signatures on the amicus brief. There's that going on, and hopefully Inflation Reduction Act gets reduced to nothing that affects crypto. But yeah, crazy times. Everyone, last word. We'll start with Papa B first. You have 10 seconds for you, and everyone else gets at least 30 seconds. But what do you want to say? What do you want to take us out on?
Thank you very much, Carlos. And I yield the remainder of my time to the wonderful lady from Northern California.
Yeah, talking about taxes is always bittersweet. So it's really depressing, but it's good to have all the information. So thank you for coming on and sharing. And for being one of the few crypto tax advisors and training all the other tax advisors on it. That's still really important. And I know it's having a big effect, rippling across. So you are helping out a lot of crypto investors indirectly with that. So good work.
Thank you, Crypty. You're so nice. It's usually in my cup says, "Eat, sleep, it's crossed out, taxes, and repeat." That's all I do.
It just feels so perpetual. Like as soon as the year, taxes are just like all year long. I feel like.
Yeah, I don't take a break. It's a year-long thing. Tax planning is a massive thing, because then we're dealing with massive capital gains, or, how is it that I can reduce legally the stuff that I have, right? Like, how do I reduce it? And what are the incentives that the government wants you to invest in or move your money into so they can go ahead and reduce your taxes? So it's a fun conversation, and it's a long year conversation that you should be talking with your CPA about, so you can reduce it as much as possible. And also, some of those things actually make you increase your wealth as well. So investing in real estate, looking outside of crypto would be good for someone. Side gigs, investing, your stock market portfolio, your retirement planning, your estate planning, as well as real estate planning. It's all a pretty fun thing to talk about. Could be a learning curve for a lot of people, but it's a beautiful thing. I love it.
If anyone wants to see,
I'm glad you love it.
if anyone else
You're
wants to see more streams, like weird in a good way, more streams with me and Carlos, we did a whole financial thing. I forget what it's called, but type in Carlos Quintana, RHMax, something like that. We did other streams, talked about different investment options and things too, which was really good. So anyways, Carlos, where can people find you if they want to get in touch?
Twitter. I like Twitter a lot. So X. It's called X. So at Carlos Quintana, they can just find me.
Perfect. Well, thanks again, man. It's really great. Always great to have you on the show. We always learn a lot and get a chance and opportunity to ask questions that are just people have a lot of, especially in crypto, they have a lot of unknowns. They're like, okay, I want to provide a forum for people to just comfortably come out, ask questions, and get some. Ask a professional who's been dealing with a lot of stuff. And I think you've had some HEX clients as well, and you've been around the community for a while. So it's really cool to have you around. And like Crypty said, we really appreciate you.
I have a lot of questions too, man, but sometimes I don't have anyone to turn to. So it's nice to just talk it out with you guys.
Yeah, of course. All right, everyone, that's all we got for you. Short and sweet. Hope you got a lot of value out of this one. Everyone, Papa Boner, Crypty, and Carlos D. Quintana. We are Scivive. I gotta do the intro or the outro. Scivive and 5555. We are out.